All right. Good afternoon, everyone. Welcome to this TradeStation webinar. Today, we're going to do futures options replay. This is an opportunity where we look at the markets and look at different scenarios where a futures options strategy would have made sense. We'll look at the reasons why a trade like that made sense and the reasons why it worked or didn't work. So this is a very practical way of looking at trades and just gives you a little bit more of an idea on how to implement these strategies on everyday scenarios. We have a guest speaker. His name is Brandon Wendell. If this is not your first time on Futures Options Replay, you know him already. We're going to pass the microphone over to him in just a bit. But before we do, let's go through some introductions and some disclosures. My name is Jesus Nava, by the way. I'm the Director of Client Training and Education for TradeStation Securities. I always like to have or do these classes because I get to, first of all, get to meet you in a live setting and also learn a little bit about how you approach the markets. Today, we're going to do that with Brandon. He's going to tell us what he looks at and try to learn a little bit about his approach. A few things we need to keep in mind. Any simple idea that we talk about here today is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. All examples are hypotheticals and they're not guarantee of future results. If anybody needs additional information on these disclosures, go to www.tradestation.com/, this important dash information somewhere. There it is, towards the bottom of this page. Also want to point out that even though it's a pleasure to have Brandon here with us, he's not affiliated with TradeStation, but we are going to enjoy his presentation and learn from his instructions. So one thing that I wanted to note is telling everyone where these sessions are being recorded. As I said at the very beginning, this is the Futures Options Replay. So if you go to the TradeStation website and hover over Learn, we have a section dedicated to futures education. Once you go there, it'll load the page, and all you need to do is scroll on the page a little bit. By the way, you'll find a great futures guide, but the next box over is the futures options replay. And if you click on watch previous, you get access to all the recordings that we've done with Brandon and all the different trades that he has explained. We title each presentation differently so you know what particular strategy was presented, and that way they're not all the same. But this is where the recording will be posted, so make sure that you bookmark the page and come back to it later if you want to review any of the content. Okay, let me go ahead and stop my share. I'm gonna mute my microphone as well and pass the microphone over to Brandon. Brandon, great to have you here. Go ahead, the floor is all yours.
All right. Thank you very much, Jesus. Glad to be back. Welcome, everyone. Thank you. And hopefully everybody's having a great end of June, beginning of July, summer season kicking off. Let me go ahead and share my desktop with you. And there we go. You should be able to see it. My name is Brandon Wendell. I'm a chartered market technician. As Jesus mentioned, I don't work for TradeStation. I'm an independent educator and independent trader. So I do trading full time for myself, and I mentor traders as well. So they've asked me to come in, TradeStation has asked me to come in and talk to you about trading options on futures and other subjects. I've been involved in the markets for about almost 30 years now, well over 25, 26 years, and started off as a retail broker. I moved into back office operations where I ended up working as a trader for the brokerage, parlayed that into a career in a private hedge fund for a little bit. Decided I didn't really care for the stress of that, moved into basically trading for myself, and then started education and teaching others as well because someone helped me. I figured pay it forward. Plus, a little selfishly, it makes me a better trader if I'm constantly reinforcing other people to follow rules. I make sure I follow those rules myself. Basically, I'm here, like I said, to talk a little bit about some trades that I've gone over and or done and show you how they can be employed in the TradeStation FuturesPlus program, as well as analyzing them in the TradeStation platform, the desktop platform. Unfortunately, with the TradeStation desktop, you can only analyze options on futures. I actually have that open currently. So here I am. I was looking at the Swissy. I'll get back to that in a moment. But you can also, if I open up under apps, Option Station Pro, obviously we can do charting on futures. That's easy because we can trade futures with TradeStation. But to trade options on futures, you cannot do that using Option Station Pro. You can see the futures options, you can analyze the futures options, you can choose strategies, but you can't create a position, can't trade it. So for instance, if I were to look at, say, the NQ, to NQU25, I can call up the options. We currently have the September options on the September contract. However, if I click buy, it says right here, hey, you can't actually trade it. You can only view and do analysis here. If you want to actually trade it, you got to do it on TradeStation Futures Plus. And that's fine. So I can go ahead and continue, and it'll create that order ticket for me because it said, whoops, should be down here. Pop up the order ticket. Come on, why is it not? Oh, that's why, because I forgot to change this to analyze trade. So you see, if I click analyze trade rather than trade, when I click on that position, now it loads it up as a position I can analyze. And I can analyze spreads, I can do all those sorts of things. But like I said, if I actually want to pull the trigger, I have to have a TradeStation Futures Plus trading account. And this is TradeStation Futures Plus, where I can actually see, in this case, the options on the NASDAQ. It's going to load up the data there to take a few moments. But there are the September options we were just looking at, and I can create positions here. So just keep that in mind that if you want to trade options on futures, you must use TradeStation Futures Plus. There's more information for that on TradeStation's website, as well as contacting the trade desk if you need more info on that. So basically, I was doing some of my own analysis, and I use both TradeStation and TradeStation Futures Plus. You can see that one of the things I was looking at was the Swissy, and I brought up the chart of the September Swiss franc futures. Is this going to work? Oh, might not have it open. Hold on. Now let's see. There we go. So I can zoom in. You can see that I'm looking at, oops, come on. There we go. 6S25. And I have it on a 60-minute time frame for this. Now, if you're looking at TradeStation desktop, you're going to have different symbols for the futures and the options. And you're going to have different symbols on the futures. You'll notice that I was just mentioning this is 6S. That is the electronic symbol, which is the one that's actually being used here in Futures Plus. Looking over at TradeStation, Option Station Pro, if I try to do 6SU25, it's not going to recognize the symbol. It's basically not doing anything. It's an error on the symbol. Go back to options, nothing changed. The reason why is you have to use the pit symbols for TradeStation's platform. And that would be SFU25. So I'll get the same options, but I have to view the right symbol. In this case, it's SFU. Now, to make it a little more confusing, not that we're trying to, but that's just the way it happens, the options themselves have their own symbols, independent of the underlying security. So for the Swiss franc, you can see we have multiple symbols available. And if you're not familiar with all the symbols, don't worry, you don't have to memorize them. You can actually go to the CME website, cmegroup.com. And I've mentioned this before, but there's a nice tool called Contract Directory and Calendar Tool. So under the search, you just go Contract Directory by looking up with the magnifying glass on the home page. And there it is, Contract Directory and Calendar Tool. This will give you the symbols for the underlying security as well as the options, which is nice. So again, if I was looking at Forex, there it is, Swiss franc, there it is. And I can see 6S is the symbol that I would use, but CHU, and I'll click on that, that is the option symbol. See, we have CHU and 5, and then I have some other symbols that'll pop up. Let me go to July, and you'll see we have 2 SFN, 3 SFN, 4 SFN, 1 SFQ. The letters at the end in number, those are the months and year for expiration. N is July, Q is August. That remains the same for futures as it does for the options. Okay, I don't want to turn this into basic option stuff. We've done some lessons on that previously, but the other ones are weeks. So this has weekly options that expire first week of the month, second week of the month, third and fourth week of the month, or monthly, CHU and 5. Yeah, it's Swiss franc, and it's U. Let's see, what does that stand for? U is the quarterly or monthly, maybe. I have to look at the, anyway, you can click on it and tell me exactly what it is. This is the monthly option, and U is monthly. So you have monthly right here that expires for August. The July expires on the 3rd, August expires on the 8th. That's all it is. And I'll tell you a little bit more about the option there. If you want to know more about the underlying future that it's trading on, you just click on future and it tells you all that as well. Now, for TradeStation symbols, again, they're using the old pit symbol, so I had to use SF. I could not use 6S when I was looking at TradeStation. Those you can actually get on the website, tradestation.com. Under pricing, you can go to futures margin rates, and that'll actually show you all the symbols. Of course, it'll show you the margin rates as well for trading those. But for instance, I would go to currencies and I work my way down until I see Swiss franc, and there it is. Swiss franc, US dollar, symbol root. Oops, sorry, too high. Symbol root is SF. So a lot of the symbols are different because there's electronic versions and then there's the pit symbols, but not all of them are different. Like ES is the same, electronic S&P or E-mini S&P, NASDAQ NQ, YM for the Dow. But you have the euro is EC, or it could be 6E, depending on where you're trading. So again, TradeStation uses pit symbols in TradeStation Desktop as well as OptionStation Pro. TradeStation's FuturesPlus uses the electronic symbols, and you just have to be adaptive and use the right symbols. That's all. So looking at the Swissy, basically what happened was I was going back a little bit a couple of weeks ago. I know it wasn't even that long ago. It was like a week ago. I was looking at my computer and I saw this. As a matter of fact, let me see. I've got, there it is, a bullish chart. I happened to drop down to a 60-minute time frame, and I was looking at this bullish chart on the 60-minute time frame. As a matter of fact, let me go back a little bit here to the live chart now. There it is. I recreated the chart, bullish trend right now. I can even see with the RSI, we had lots of bullish momentum. We're at about 80, above 80. So very bullish, very overbought, but that doesn't mean it won't become more overbought. Got to be careful there. I can also look at a little bit bigger picture. If I go to 240-minute time frame, and again, this is back on the 24th. So let me pull this back. Oops, not what I want to do. Why is that moving? Anyway, I can't adjust it back, but you can see we came from flat movement to upward bullish trend on the 24th. So I saw that we were in a bullish trend and likely to continue that bullish trend, which we obviously have. And that's not what I wanted to do. Come on, give me back my time frame. 60-minute. There we go. And I go back. Unfortunately, messed up one line here. There. Now, when I trade a little different than a lot of traders do, a lot of technical analysts, for the most part, will use this stuff called support and resistance. And I really don't. I'm looking at what's called supply and demand. And the reason why I use that is it works very well for me. But basically, I'm trying to piggyback off of institutional order flow. And what I'm looking for are patterns in the markets that reflect where institutional traders have been buying or selling. Okay. And I'm not going to be able to get into full detail about that today. I've done some workshops with TradeStation about it before, and there's plenty of stuff. If you look me up, you can find me on all the socials. If you got questions, also want to contact me, you can email education@tradestation.com and look forward to message to me. But basically, what I identified here was an imbalance where there was lots of bullish pressure, lots of buying, but not a lot of selling in that area. We had an imbalance. So in my mind, we had a bullish trend. We're making higher lows and higher highs. Even though it was overbought, it was likely to become more overbought. It's a strong trend. There was nothing overhead saying we were going to stall out anytime soon. So I became bullish on this security. Again, going back to my PowerPoint here, bullish on a daily chart. So I actually did take the pictures, and bullish on a 60-minute chart. So I zoomed in, I found that area that I just mentioned, that origin of imbalance, and this is the picture I took on that day. And I even used Fibonacci extensions because I didn't have any overhead supply or even resistance by going back in time anywhere nearby. So I wanted to get an idea of where prices are likely to stall so that way I can set up a position. Now, as a bullish trader, I've got a few different choices of what I want to trade. One choice would be buy a call. Right? It's a simple single leg strategy. A nice advantage of a single leg strategy is it's simple to get into, simple to get out of. The disadvantage is when you buy that option, you are accepting all the risk of that particular option, which means you pay that premium, you 100% could lose, or sorry, you could lose 100% of that premium. course, right? Things go down instead of up, and I could lose 100% of that premium that I paid. Doesn't mean I will. I should have a stop loss in place to protect myself, but I might want to reduce my risk. And it's not just directional risk. I have time value that's decaying. Basically, when you get into an option, and let's use TradeStation Option Station, to be able to take a look at this Option Station Pro. And let's see, we'll use what do we have here? August. Let me see, which I think I used September options actually, because I wanted time. So looking at the September options on this Swiss franc right now, we're currently trading at about 127.28. So if we did the 127 calls and bought, there we go, we'll create that position. Even before I go to that page, let me go back to the options. Unfortunately, I have theoretical values. It's not a big deal. It's a little undervalued. It's perfect. Theoretical value is higher than what I could buy it for. I have a delta of 0.53, which means for every 1 point that the price of the underlying moves up, I make 53% of that, or 53 cents. But here's the other issues I'm going to have. I have a little bit of gamma. I don't know why it's not showing any theta or vega currently, maybe because the market's closed. But I do have volatility risk, and I risk if the volatility drops, I'll lose money in the position. I'll show you. If we go back to analysis, and this is, let's see, 0 DTE. Okay. So here's last price. And you can see I've got a negative number right now. Let's say that, let's go to current price, actually, or current time. There we go. And I'm going to remove some of these others. Right here, this is now. And right now, if I buy this thing at, what price was I looking at, about 2 cents, 0.0208 for 127 strike call, my profit and loss is basically nothing right now because I'm getting in. But watch what happens if volatility were to drop. Let's say it goes down by 3%. It's not a huge adjustment, but it's something. Look at how much I lose all of a sudden. $800. Price didn't move. Time didn't change. All that happened was volatility dropped and I lost 800 bucks. That's not good. So I would need to protect myself against a drop in volatility, because I don't know, I didn't show you, but going back in the slide sheet back here on this one, I was using Chaikin volume as an indicator of volatility. So I was trying to measure volatility, and you can see we came off the highs in volatility, but we're still in the midpoint. Well, when you're in the mid, prices can go either up or down. And the value of volatility could go up or down. What if volatility goes up? If volatility went up and I bought a call option, I obviously make money. But I'm worried about my downside risk. What's going to affect me? What's going to hurt me? One, time's going to pass and I have time decay on my long option. Two, what if volatility drops? As you just saw, a small drop in volatility, heck, I'll make this only 1%. Again, price didn't change. Time didn't change. I changed volatility by 1% and I'm down over 250 bucks. Even though prices didn't go anywhere, time didn't go anywhere. So how do I protect myself against some of that time value decay, time decay dropping? And how do I protect myself against some of that volatility drop? Well, I create a vertical spread. By buying an option in addition to the one that I sold, I now reduce my risk by basically collecting positives to offset my negatives. What I mean by that is, going back to the option here, that 127 call had positive delta, positive gamma. It had negative theta. It's not showing right now, but it has negative theta. See, did any of these show? Really odd. Let's go to NASDAQ or ES just to demonstrate for now. There we go. Now we got it. So let's say we're looking at the 6250 calls right here, at the money calls. Okay. Basically, you've got positive delta, positive gamma, negative 101 for your theta, and a vega of 11.63. That means if volatility drops by 1 point, we lose $11.63 for our option. And that's going to be, again, you can see when it moves, it can move. So if I, again, buy that option, here we are, and I did a -1 on the volatility. Sorry, it's P&L. That's right. I wanted to go to now. Is that right? Let me see. 0 and volatility. Sounds not right with that pricing. see, pinned. Oh, that's why last. There we go. That's better. So here we have no loss. However, if I do a drop in volatility of 1%, I lose $582. Wow, that's crazy. Just from a 1% change of volatility, no price change, nothing else. Just a 1% change of volatility. Now, the way I combat that, as I said, is I create a spread. So I'll keep that one there for now. I'm going to do back to options. Instead of just buying a call, I could sell a higher strike call. Now, what am I gaining from this? I'm gaining protection because I have positive theta that's going to offset my negative theta. We had negative 101. We're now going to take this negative 98 and make it a positive, and we're going to reduce our overall theta. Look at this, 1.82. Yeah, it's basically times 100. Okay, so you have 1.01 minus 97, and it becomes 1.82. That's all right. Anyway, the delta, I'm sorry, not delta, the vega also changes. It's not showing here. I actually have to go to analyze to see the vega. And we'll take this one off. And there's that spread I was just dealing with. Last price. Now look, the theta, or sorry, the P&L right now at current price, it's going to change just a little bit, but it's pretty much a break even. This is what we're paying right now for it. If I do negative 1% of volatility, now how much am I losing? Basically, instead of losing $500, I'm losing $3.18. Now, if I go back to just the single option, look at that. The negative 1% in volatility, I dropped $581 in value. But by doing the vertical spread, if volatility drops, I'm losing almost $3, or a little over $3. That's nothing. That's why I can do a spread. Now, on the other side, by reducing my risk, it's going to reduce my profit as well. If prices were to go up, let's say we go to period 2, so time passes, and that volatility drops. Let's say it drops by, no, let's keep it the 1%. But in this case, prices actually went up by, let's say, 5%. I have a profit. But here's the thing. If I just done the long call, my profit would be much bigger, wouldn't it? $8,092 versus $784. But I'm also going to be paying a lot more for this. So what is my rate of return really? For the single option, my P&L, that single call option, let's do that one first. I'd be making about $8,100, we'll call it. But I had to spend basically, is that right? $8,268 to buy it. I didn't do that right. So I made basically 98% rate of return. However, I reduced my risk. I'm not going to get the same great return. In this case, I'm making $788, and I only had to use $1,400 as my max loss, the premium I paid. Actually, not even the premium I paid. That's the max loss, which is the spread, the distance between the two strikes minus the premium I paid. So in this case, the cost is $2,850 times the point value. Let's see, this is Swissy. That's all right. I forget what the multiplier is for this, for the point, for the cost of that right now. That'd be $2,850. Should be the spread, $2,850 times the point value. Anyway, my rate of return was going to be much better because I'm not going to be having to put up as much cash in order to be able to get into position. And I protected myself against a volatility drop. So the choices I have when it comes to this, also based on the volatility, like I said, we're in the middle here. So we could have volatility go up or we could have volatility go down. If volatility went up, is going to go up, we're expecting it to rise, then basically we want to be in a debit position that's going to have some positive vega, because that'll give us a bonus in our move to the upside. We'll make a little bit extra from that upward movement. But if we expect volatility to drop, we may want to put on a credit spread and therefore profit from the drop in volatility as well as possible price movement. So I actually did both. The debit spread on the bullish opportunity was a bull call spread. And it was basically buying the 126 call and selling the 127.50 call. So I bought a call pretty much at the money, and it was a little bit out of the money, I think. At the time, we were, just slightly out of the money, expecting prices to go up, and selling a call much, much higher. The alternative, as I said, if I thought the volatility was going to go the other way and drop, I could do a credit spread, which this would be a bull put spread where I'd sell an at the money option and then I'd buy a deeper out of the money option, lower price. And I profit by keeping the premium I collected if prices go up and the options expire. So let's go take a look at our live chart. Oops, just passed it. First of all, what happened with the trade? Well, you can see prices came down and they actually right here hit my area of demand. And that was on when was it? 25th of June, Wednesday of last week. So one day after I put on the trade idea, it came down, hit my entry point and bounced. And it created some new demand up a little bit higher. Still hasn't pulled back to that level, and it's gone even higher yet. So it's definitely right in the direction. Question is, was I right in my positions? If I had simply bought a call, I probably would make a lot more money, again, because I capped off my potential profit by buying a call and selling a higher strike call. So if we go take a look at the live positions right now, I still have them open. I didn't close them out, even though I could have and probably should have, honestly. I'll explain why in a moment. Where is it here? CHU, there we are. We'll get to the others later. And we can probably zoom in on this. Oops, there we are. So there's the position, or two positions. As I said, I have a bull call spread, which is basically buying 126 and selling the 127, 120, 127.50 right there. You can see I did -1 there, +1 there. And currently, the long call is up $706. The short call is down $537 for net positive. Matter of fact, what is that net positive? 706.25. It's changing a little, I think, but 537.50. So it's up 168.75. Okay, and I probably should have gotten out of that now because I'm capped. The problem is I'm capped at 127.5. If it goes anywhere above that, I can't make any more money. And where are we currently trading right now? 127.25. So I still have potential to make a little bit more money because we haven't reached the option that I sold, the 127.50s. But once we reach that area, I cannot make any more money above that. All I can do is lose my profits because the time value is going to decay. Now, it's not going to hurt me as much because I shorted and bought. Remember, I bought a call below this value and I sold the call above. It's not going to hurt as much as if I just bought the call because my theta is going to be less. But I don't want to waste time, nor do I want to waste money. Profit is profit. So I may think of getting out of this pretty soon. I've got a nice win. Okay, again, my original cost is a show average open 0.021 and 0.014. So basically, I made a nice profit on this one. I think I have to do the math on it to see exactly what it was. The alternative I said was a bull put spread. And in this case, again, zoom in, I sold 126 put and bought a lower strike put to cover this one. So that way I'm not naked. On the put that I sold, I'm up 606. On the one that I bought, I'm down 443.75. But again, added at 168. I've got both positives. We have here 606.25 minus 443.75, 162.50. So it's interesting. They both made about the same amount of money, didn't they? I think it was 168 versus 162. They were very close in value. And the reason why is the prices moved up quite a bit. So on the debit spread, I made profits on the prices moving up. On the credit spread, I made profit both from the prices moving up, the delta, but also time value and volatility changing. Because what it looks like, again, I can go back to my chart. Say volatility went down a little bit. Swiss franc, zoom out of this, and the entry spot, again, is the 24th. So back here, and I don't have it open right now, but unfortunately, I don't have all the indicators for volatility that I'd like because these are on futures, so I don't really have all the data. But one that I do have is right here, volatility, and volatility on the entry spot, again, is the 24th, right about here. You can see that we have been floating back and forth, but our volatility is pretty much currently right where it was when I got in. So I was protected when volatility went up or down. obviously because I had both the positions, but because I did a spread, I didn't have nearly as much exposure to volatility as if I had done a single leg option. And it worked out. Like I said, I can probably close out of both positions if I choose to and walk away with a nice profit of $300+. But simple things like that to take advantage of a little bit of protection at the cost of limiting your rewards a little bit. As I said, we are taking away some of the potential for rewards. I didn't expect prices to go up forever. As a matter of fact, I think I put it in the picture. Yeah. I was using projections to figure out where we were likely to stop. And I chose the closest strike to just above that area. So I noticed on a Fibonacci projection, I figured we were a very strong trend. We're probably going to go at least 100% of the previous impulse, if not a little bit more. We're actually sitting right now just above that 161.8. Show you. I'll get rid of this indicator for now. Zoom out. And using the Fibonacci extensions or projections. Where are you? Come on. I went right here. This was our most recent impulse up. Oh, come on. Hang on, screw that up. Let's try that again. There we go. Up. And I was expecting to come back about here. And you can see it went a little bit further, but hang on, they put in too many fib extensions. Oops. Those are the main ones I use. I use the 61.8% projection, 100%, 127.2, and 161.8%. And sure enough, our first impulse back up stalled out right at 100% of the previous impulse. And then it looks like it went to 127.2 and is now stalling near the next level of 161.8. Pretty good. Forex works pretty well with the Fibonacci's if you know how to use them properly. You can use those to project possible turning points in the price. So I've got another decision, actually. We still have a nice bullish trend going on right now. I can also, again, take a look at maybe daily time frame and see, is this likely to continue? Looks like we got a nice bullish trend. I don't really have anything overhead to stop us. Oops, yeah, it keeps moving on me. Come on. So we have a move that's likely to continue to the upside. The reason why I point that out is I could probably do this whole thing again if I time this right. Again, going back to my intervals on the 60-minute. I'm going to just move these if it lets me. Oh, there it is. Okay. It's not as easy to draw as it is on TradeStation desktop, but you get used to it. Honestly, I could actually do the analysis on TradeStation desktop as well. And let's do that because I'll be much faster with it anyway. So here we are on TradeStation once again. And you can see I already actually did the fibs on that one from the previous trade, but let's do this on the new area that we're looking at. Go over there. And it looks like I'm already set up. We got right here, basing a nice rally. It's a demand zone where prices are likely to bounce should we return to that area. So once again, I can figure out, okay, what's the volatility looking like? Remember, I said it's pretty much right where it was before. So in the middle, which means that I could probably choose either a debit or credit strategy, whichever one I want. Come on. There we go. We haven't completely topped out as of yet. And I'm not going to draw these lines on this time frame. I'm going to go a little bit bigger and draw them on my trend time frame because I need to identify the most recent impulse in price in order to draw the fib properly. So it looks like that impulse started right there, waiting for a correction back down. Nah, it does that. All right, we'll redo it. Fib extension, again, it was from here to the high, possibly retracing back, and I forgot I got snap mode on, so now I got to change it this way. 126,630. There it is. And there it is. So I could choose to do a bull call spread yet again, where I buy a call at the demand zone. Now, I wouldn't do it yet because I want to wait for prices to come down to that area. So honestly, what I would be doing right now is simply setting up an alert and waiting for prices to come to that area. But I could set up the bull call spread just as I did before. And I would sell a strike either at the 100% or just above, maybe at the 161.8 if I think it's still going to continue very strongly. But usually once you get a big move like we already experienced, you're not going to get it again. You're going to get a smaller move before prices turn or pause. So I might want to buy 126,500 and sell 127,500 or 128. But again, I don't do that until prices return to my demand. There's another trade I'm actually waiting on right now, and that's on milk. If you take a look at my charts, here I am on the daily chart, milk, DC for July. Might have to roll this over because I'm not sure when this one when the milk expires. I also have to redo my projections here as well. I'm gonna have to delete that for now. There you go. Because if I'm looking for some lows, I've got nothing behind this for this contract. So I'm going to use a projection on the most recent impulse. Once again, I'm on a daily chart, so I might go to weekly. It lets me, no, that's not how you do it. I can do it this way. We're on DC for July. Sorry, I forgot the C. DC. Is that the right symbol? Okay, since I don't have the right symbol, again, I just have to look it up. And where did I put the browser? TradeStation, futures margin rates, milk. May not be available, depends on the platform. There it is, milk. DA is what I'm looking for. Okay, no big deal. So DAN 25. There we are. And I want daily. Voila. So we're almost in my area of supply. Again, it's a little bit of basing right here and nice imbalance, selling pressure to downside. Now I can go to the weekly from the daily chart. And actually, my whole big move is the impulse to the downside. So for projection purposes, I go from high of the impulse to low to where it's retracing. What happened? I think I might have clicked that wrong. Yep. I delete it for now. Redo. 1, 2, 3. Edit. I need to go up to 1795. And under settings, I want 127.2 and 160. Oh, I didn't have it there. Okay. I just had an extra. So that's it. There's my projection. Go back to the daily. And now, again, I have to wait for prices to come to my area. I need to check on volatility to see if I should be doing debit or credit spreads. But I have a possible upcoming trade for futures on milk. And what I'll do is I'll go ahead and put together this trade with my alerts. In our next session we get together, we'll see how that works out. There was another trade I was looking at as well. I have that in my charts. Or not another one that I was looking at, is one that I did. Where are you? Oh, it's on this. And it's platinum. Unfortunately, this one didn't work out as well as I expected to, but you'll see how it turns out because, again, I want to protect myself instead of just going in a direction, bullish or bearish, with a single leg option, which is very simple. It exposes me to too much risk, and I can control my risk and minimize it by using the vertical spreads instead. So initially, looking at this trade, let me see where my pictures. I have a whole file of screenshots that I did. I started off with a 4-hour chart on the 24th as well. And with this, I was looking at platinum, and this is the October platinum futures. I want to trade the one with the most volume, and that's typically the front month contract looking forward. So I looked to see which one has the heaviest volume, and it happened to be platinum because we've gone from the July already. So here we had an imbalance of demand that was already tested. And here we have a rally-based drop supply zone that we are coming close to, but haven't broken. So at the time, I was expecting this to turn to the downside and become more bearish. I was expecting it to drop from around 1335 down to roughly 1225 or even 1200, basically coming down to test this untested demand zone. Figured to bypass this because we'd already been there. Volatility was middle of the road. And what I don't show right here, which I use as well, is my RSI. So looking right now, platinum, going back to where it was, this is the 4-hour time frame on platinum on the 24th. You can see that we actually did have bullish pressure, not very strong bullish pressure, but one of the things I do is I modify my RSI a little bit. You'll notice my settings. I use a 14 period, which is pretty standard. It's default for most platforms, but I use 60 for overbought. I use 40 for oversold. And I'm actually not using this RSI for overbought or oversold. I'm using it to help me with momentum. So this is something I learned when I was studying for my CMT designation. I use it as a momentum indicator, and overbought, I said this before, that can become more overbought. Oversold can become more oversold. That's the nature of a trend. So what I'm looking for are changes in the momentum, not overbought, oversold. And those crossings above and below, normally it's 70-30 for the RSI. Those always happen at least one candle late because the crossing can't be confirmed until the close of the current candle. So that's the flaw with a lot of technical indicators. They're all delayed by at least one candle. So I use this a little bit differently. One of the main things I'm looking for, and we see it here, this is after the fact, but one of the main things I'm looking for is something called divergence, where you can see prices were making higher highs, but the price was doing it with less momentum. It's kind of like a bridge. If you got the bridge supports, that's the RSI and the pressure, buying pressure, if it's not built all the way up to touch the bridge, if they're stopping short, that's not going to hold the bridge. The bridge doesn't have support, it's going to fall. And what happened? Negative divergence here, prices fell. So I noticed that was happening after I'd already gotten bullish and gotten into the trade. Before that, so what we're looking at on the chart, and we weren't as bullish as we had been before, but my mistake was I didn't realize we were above 60. So that means we are still in bullish trend and bullish territory. So we might still have enough energy to keep going up. And sure enough, it did. So I started going into a losing position, but I had plenty of time. And once I saw the negative divergence, I figured I have a shot for this coming back at least. And that's exactly what it's done. We're going to delete the original lines. You can see how we came back. So currently my positions are actually in a losing area because I was expecting to be bearish. But the nice thing is I'm not extremely negative because I put in that protection of using spreads rather than trying to do a single leg option. So let's take a look at where we're at right here and the different trades I put in. I actually tried with a bunch of different trades, I believe. There it is. And the symbol, by the way, is P for platinum instead of PL. The option symbol is PO. And you'll notice I have quite a few calls and puts all together. And I, again, put these in as trades. And honestly, the trade right now should be losing quite a bit. It's not, though, because of the protection I put in. The underlying price is currently 1363. I was bearish originally at somewhere around 1330, I believe it was. I forget what the exact level was originally, but I'm not that negative because I put in the correct positions, put in the spreads. So what I have here are, I believe, two bear call spreads and two bear put spreads. Let me see. I separated them in a Word document to make it a little bit easier just to see them. And I have a 1360, 1350 bear call spread where basically I sold call and bought the higher strike call. I also did it with 1345 and 55 as prices were moving down that day. On the bear put spread, I bought the first one, 1340, sold the 1220. Expecting it was only going to go down to about 1225 or 1220. I also did the 1335 and 1200s. So basically, that's how I have to combine these. And unfortunately, because I did not put them into spreads into an actual position, it's hard to see what's going on with them. I have to piece them together. That's why when you're putting in the trades simulated, you have a choice. One of the ways you can do it is individually, like I did, where I went in and leg by leg, I just went and opened up an order ticket or clicked on it, bought or sold. So I create the position by going in on my long first and then my short. So I'm not naked. The alternative would be to find the position in MD Trader. So let's see, we go to MD Trader, or actually Explore, and I can look for the vertical spreads. I think there's the other way I can also look is, no, I probably wouldn't, because I have the options chain. I can't use the strategy creation only in live. In live, it'd be so simple because I can go to strategy creation. You can see it's not supported simulation, but I can go to my templates and create vertical spread. Where is it? There's vertical spread. And I just put in the two legs, then I can create the spread. I can also create it as a watch list in simulated mode. I just can't trade it. So if it changes the watch, for instance, I could go ahead and do, let's say I want to do where are we currently? Let's say I want to do a bear call spread right now, sitting about 1364. So the one I would sell, it's bear call. Again, I'd find PO. Oh, come on. Under search, PO, platinum option, month, October, not September, October, and the strike. It's about 1365. So we're sitting. Click on again, PO, platinum option. And the one I'm going to buy, again, October, is going to be a lower strike. And I would do my analysis to figure out where it's likely to go to. I'm just going to go ahead and place right now let's say 1300. There we go. Yeah, maybe not that low. I'll leave it for now. So right here, I can just do watch because I can't put it in the trade, unfortunately, and I put it in my watch list. There it is. PO, call 1300, call 1465. I can just watch the spread there or watch the trade there. Now, if I want to put it in as a simulated trade, I just go over to my option chain. There we are, PO. And there's the options, October. And you can see which ones I'm short and long by looking at the page right here. But if I want to create a new position, I could go ahead and look for it basically under Explore and look under MD Trader and create the spread. So let's see, probably easiest thing to do. Go open MD Trader. Actually, that's not the way to open up the Explorer for it, but let's see, can I change it here? Change instrument. There we go. Spread. So right here, I went CME, and instead of the option I was on, I went to spread. Then I go to PO, and it should list the spreads there. Not sure why it's not. Maybe PL. There we go. That's doing the futures. I don't want the futures there. So let's try auto spreader. No, that's not it either. I thought there was an easier way to find it this way. Oh, there we go. I went to set instrument. It was already set on PO, and I just hit enter. And there we have the options. Those are the single options, but I should be able to find the spread here as well. And it doesn't look, it looks like that's the single option. So let me escape out of that. I forget exactly where it is. Jesus, I don't know if you're still here with me, but you can find the Explorer to bring up the
At the top.
options. Sorry?
You're looking for Explore?
Yeah, to find the option spreads.
Right at the top where it says search, just hit on Explore.
Oh, okay. Which one do I use?
Use strategy if you want to look for option strategy.
There it is. Okay. So again, I go P. Nope. And you just have to scroll down to the right symbol again. So it should be PO. It's going too far.
The scrolling is kind of tricky.
Yeah, it takes a little while. There it was. I went too fast. Okay, PO. And there we are. Unfortunately, you have to scroll through these.
Or you can just click on more at the bottom. See the bottom left corner. You can then specify which strategies you use.
There we go. Perfect. Vertical strikes. And we're looking at, of course, 1400 is not showing there, but dude, and it's only showing a couple of them though, unfortunately.
Yeah, if it doesn't show, they have to go through the strategy creation.
Okay. Huh.
So the one you created doesn't show, right?
Yeah, it's not showing the ones I want, unfortunately. So it's something to do with my single legs, or I have to create it. But anyway, I just did them single legs because that's the easiest way for me to do it. In the live, obviously, it's so much easier. You just go ahead and use the strategy creation. But in the simulator, I had to do this. But anyway, what I was getting at is overall, the position is not really that negative again. And the reason why, even though the prices are going against me in it, I have the protection from the vertical spreads where I have the positives offsetting a lot of the negatives rather than just having the negatives altogether. So it is in a negative position, but not nearly as bad as it could be. And it was almost break even or even positive earlier in the day until prices started moving a little against me. But those are some of the positions I'm looking at. Again, we'll come back on our next session and see how the milk trade plays out, because that's what I'm looking at. I've got a couple others that I got my eye on as well. So hopefully I give you a little more insight into some of the vertical spread opportunities, especially, like I said, on the Swiss franc. That was an hourly opportunity, and looking at the new possibility coming up as well. So still positive on that. And yeah, I'm going to go ahead and run out of time here. So I'm going to go ahead and turn this back over to Jesus. I want to thank everybody for their time. And hopefully, if you got any questions, again, email us education@tradestation.com and let us know what you'd like to see in some of the future sessions.
Thank you, Brandon. And just to let you know, guys, our team of developers and product managers are working hard to make this whole experience a little bit better, so we don't have to be switching back and forth between OptionStation Pro and then FuturesPlus. Our objective is to provide you a unified experience, and we're working really hard towards that. So thank you for your patience, thank you for your support, and Brandon, again, thank you for your expertise on these subjects. I'm sure that the audience really appreciates them. Everyone, have a wonderful day. Just keep an eye on our future events. We do futures options replay once in a while. Check our events calendar for the next one. And if you're looking for the recording, just go to the Learn section of our website, TradeStation.com, and you'll find futures education there, okay? Thank you, Brandon. Thank you, everyone. Have a wonderful night. Thank you for being here. Bye-bye.